Hi, this week we have three interesting webinars lined up for you. First one is on top biases you should fight. This webinar is happening at 10 a.m. At 12 p.m. we have navigating the cement business. We have another webinar at 12 p.m. which is using MS for asset allocation. All the registration links for the webinar are given in the description below. Do register. Thanks.
As an investor, you probably have some interesting observations on the bond markets today. So, in the last month, we've seen interest rates go down with RBI rate cut actions, yet bond portfolios have really not performed that well. In fact, instead of giving positive returns, they've been delivering negative returns. So, a lot of investors are wondering what's going on in this space. In this video, we're going to break down what's happening, why it's happening, and where we could go from here. You still have any questions about what's happening on the fixed income space? Comment them below and we'll be happy to address it in our next video. So often investors get confused because they think interest rates and yields are the same thing. However, there is a small difference between what your interest rate is and what your yield is. Interest rates are a policy tool that a central bank uses, which they can adjust upwards or downwards, and yields are the market-linked rate. So, whenever the central bank makes a particular change on the interest rate side, it takes time to flow onto the market side. This process is known as transmission. So, there is a lag in terms of interest rate changes versus market actually responding to those changes. And this transmission is what causes a lot of differences in terms of what we expect versus what actually occurs. Let's also talk about what duration is. Duration is a metric that is used in the industry to measure how sensitive a bond's price is to changes in the interest rate. So when you have longer duration bonds, they tend to be more sensitive to changes in interest rates, primarily because, let's say, you were earning 7% on a 10-year bond and you lock into this, and then the rates start coming down, new 10-year bonds will be issued at lower interest rates or lower yields. So then your bond becomes more valuable and the bond price for what you own actually goes up. But if you were caught on the other end of the cycle, let's say you owned a 10-year bond at 6% and the interest rates start moving up, then a new bond would come in at 7% and be more attractive than what you own. So the demand for your bond would go down and the price would automatically adjust downwards as well. So this logic ensures that when yields move down or rates move down, prices move up. And when yields move up or rates move up, you see prices go down. Now, a longer duration bond or a longer maturity bond is likely to be more sensitive because that lock-in is much longer and the time it takes to reprice also is much longer. So, you have higher duration risk at the bottom of an interest rate cycle and lower duration risk at the top of an interest rate cycle. But the key thing is that even if you're at the bottom or at the top, there is a lag in terms of monetary policy transmission, and that's where all the opportunity comes in. This brings us to what the RBI has been doing in 2025. When we study the RBI's rate actions, we realize that the RBI has basically reduced interest rates by 1% from the start of 2025 to where we are today. And this has been over the last 3 policy meetings. The RBI also changed its stance twice. So it started out the year in neutral, it moved to accommodative, and then it now has moved back to neutral. This stance change is what is getting investors a little worried, because essentially when the RBI is in a neutral stance, it can either reduce interest rates, maintain interest rates, or increase interest rates. When it's in an accommodative stance, the RBI cannot increase interest rates. They are forced to either maintain or lower interest rates. So this shift in stance effectively makes some participants think that we're at the end of the interest rate cycle. But is this actually true? We need to first study what are the factors that go into these policy decisions. When we look at the major players, you have growth and inflation as key players in this story. So if the economy is slowing down and inflation is at a low level, then it's very likely that there's room for interest rates to go lower. The idea behind lowering interest rates is to encourage more spending, encourage more leverage, as well as encourage more investments. So when this happens, you see more economic activity and you see growth trend back towards its median or average level. when you're in an economy that's growing very fast, you might want to rein it in because that could trigger inflation or other issues and bring it to a more sustainable long-term range. So this is done by increasing interest rates, which will suck out system liquidity and discourage spending to a certain extent. When this balancing act occurs, you essentially have interest rate cycles, and this is something that every investor needs to pay attention to. So coming back to the RBI's rate actions, of course, they lowered interest rates by 1% this year, but they've also ensured that system liquidity remains stable by promising to have some cash reserve ratio cuts later on in the year between September and December. This ensures that they're creating the room for monetary policy transmission by keeping liquidity ample throughout this transmission period. So markets should have reacted to this situation quite positively, given that the economy is slowing down, inflation is at a low level, and liquidity visibility is there for market participants. Yet you saw an adverse reaction on the bond side. So what actually happened here? This seems like a pretty sweet spot to be in. So why did yields actually move up? There are a variety of explanations that are available, so we'll look at a couple of them today. One is in terms of FII interest in this segment of the market. There is speculation that the yield spread between Indian bonds and US bonds has reduced, and this could have triggered an outflow given that there is no currency risk for FIIs who own dollar-based assets. The second trigger could be something along the lines of market participants feeling that we are towards the end of the rate cut cycle, and that would essentially mean that there is limited room for transmission to occur. So if we measure the market response by looking at yields from the start of June to mid-June, we realize that the 10-year government security has actually increased by 7 to 10 basis points in terms of a yield spread. Whereas, and if you look even further down the line into the 30-year security, it could be as high as 20 basis points. So these could translate into losses of roughly 0.5 to 2% for investors. And that is what is getting a lot of investors to question what is going on here. So there are two things that an investor needs to consider today when you're looking at fixed income as an asset class. The first is in terms of duration risk. And when we look at duration risk, if we think that we're at the bottom of the interest rate cycle, there is actually no way to assess that we are right at the bottom. Because firstly, the stance is neutral, which means there is room for rates to go further lower. The second is from a macroeconomic standpoint, the Indian economy is slowing down. You're also seeing lower levels of inflation than what the RBI considers healthy, right? Beyond this, at a global context, you also have a lot of global triggers and uncertainty. Whether you're looking at geopolitical risks, war, or even trade agreements, there's a lot of policy uncertainty in the global space, which could slow down the global economy. And the RBI has iterated in many of its policy meetings that global risks to the Indian slowdown do exist. More importantly, even if this is the RBI's last rate cut, we've not left enough room for transmission to occur, and the global scenario dictates that the RBI is not going to be in a hurry to raise interest rates. The second thing for investors to consider is reinvestment risk. So if you do not take a duration call today and you decide to be on the shorter end of the curve, where transmission has already been pretty swift, you're going to get lower and lower returns from fixed income. While there is a negative return that investors have experienced this month, there is scope for gilt to deliver better returns going forward. And this is where investors need to start thinking about how they want to balance their priorities between taking on duration risk versus facing reinvestment risk at the shorter end of the curve. So as an investor today, you have an interesting opportunity before you, and you can reach out to us to understand how you can exploit this opportunity in your portfolio. Thank you for watching this video.